Welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Ni hao ma! My name is Wayne. I'm a currency trader just like you. Let me close my office door. There's an echo. Come on now. All right. Boom. All right. Hey, my name is Wayne. I like currency trading. I like trading in stocks and commodities as well. Cool. Right on. So welcome to the community. Please treat each other with dignity and respect, and ask good questions, and I will do my best to serve. Please like and subscribe and leave comments. Not for me, although I did review a couple of hundred comments yesterday. Thank you for that. There were some very encouraging words. Thank you very much. But mostly for YouTube. Just tell YouTube this is quality content, and that there should be less get-rich-quick crap on YouTube and more, let's say, realistic, true education, like what we do here. So I'll let YouTube know the truth. And, of course, let me know how I can help. Let's go through the value ladder. Okay. Okay, let me pop open a browser. Is it going to even let me? Why is it taking so long? Okay, let's start with Trader's Way. Okay, why do you come here? Because it's an ECN. They support what we do, but the thing is, it's better for you because it's an ECN. Not sure why it's not. Oh, there, I can't see it. There you go. It's an ECN. That means they have straight-through processing. There's no conflict of interest. There's a symbiotic relationship. This is what you want in a broker, this technology. It's a completely different business model than most brokers out there. So find an ECN. I recommend Trader's Way. Okay, so you start with a good base. Then you need training. Video training, for example, $88 a year for, about 100 hours of lectures, not babble videos, lectures. And then you can upgrade your account to include live trading groups where you can get coaching and consultation. Okay. Hey, what a great way to learn. Video on demand. And then swing trading and day trading. It's just the difference has a lot to do with how often we meet, how much support you need. Okay. Then you upgrade or you add to your tools. Okay. Automated fundamental analysis. So that you can make informed trading and investing decisions. 20 years of seasonality. Fundamental data, institutional positioning, retail positioning, technical trends, projections into the future, and an automated process for bias. Truly, truly, truly incredible. Then you add more tools to your trading business. And that includes the automation of your technical analysis. There's a whole lot more than that, but that's the essential value proposition to you, that it does technical analysis on Forex, crypto, stock, commodities, and indices. Does the technical analysis for you. So all you have to do is line it up with your fundamental bias and you're good to go. Look, do you sell the high end of a down channel? Oh, for show. Yep. Oh, you might have missed that. Check that out. FTSE an hour ago. Okay? Gorgeous. Okay? Do you sell Nikkei on an up channel? No. But it says to. No, it doesn't. It says you're at the top of an up channel and it's likely to come down to the bottom channel. It didn't tell you to sell. Who told you that? What kind of knucklehead would think that? No. But it's an up channel, so currently you would let it fall and buy the dip. Would you sell this up channel? Yes. Or this down channel? Yes. There's a big difference. So anyways, look at this crazy technical analysis, huh? Butterfly emerging pattern 17 hours ago on the Dow. I mean, this is pretty neat stuff. So anyways, here's another butterfly on the FTSE. Interesting. So anyways, it does some pretty cool stuff for you. It does a lot more than that. But there's the value chain, if you will. A good broker, good training and good coaching, good fundamentals, and good technicals. You put them together and you have a business platform. Okay? So that you can trade with as much data as any multi-billion-dollar institutional investor, even though you're trading from your kitchen or your mom's basement. Anyways, let's get going. Cool. I guess, let's start with let's see, did we get enough votes? No, there's not enough votes. So I need a minimum of 30 votes. So we're not going to do the poll yet. Okay, so let's start with some basics here. Why am I short the NASDAQ? Because that's seasonally what usually happens. In fact, in the very beginning of January, we had this as our projective conservative high. It could go higher, but it usually doesn't this time of year. Now, it could have gone higher earlier this year, but it didn't. So this is our conservative projected high we had back in January 6 months ago. Then we said the timing of the top would probably be Canada Day. Do you know what day Canada Day was? Yesterday. So 6 months ago we said this day here. Notice the top actually was the day before. We are talking hours within our 6 month projection. Our 6 month projection was accurate within hours, not days or weeks, hours. Cool. So why am I short here? Because that's what I thought would happen in January. So anyway, so is it going to fall? Oh, I don't know. I don't know the future, but I do know the past. And that's straight out of QuantBox. Like, oh my gourd, straight out of QuantBox. So it'd be interesting to see what happens next if we get like a breakthrough. Cool. It's not wanted, but it's expected. It's what normally happens. And I covered it in today's QuantBox video. And the link I posted, I think, is for today's video. I've forgotten already. Let me see. Yeah, in 76 minutes, okay, you will find out what we talked about an hour and a half ago. Okay. How to trade with seasonality. Oh, yeah. So you might want to take a look at that. Again, here's the link. And there's another good video that you might want to watch that was uploaded. Now, there was an error. There it is. Oh, yeah, there was an error. How to trade without an underlying intrinsic trend. Yeah, guten Morgen. Welcome to QuantBox Live. It's about 7:05. Cool. Okay. Cool beans, right? Cool beans. Cool beans. So that's another great one if you want to watch it. Okay. Oh, well, Don, what's happening with the yen pairs? Good. I literally covered that this morning in the QuantBox video. But how is it that Canada Day risk-off bias has not trickled into the yen? Okay, now there's a couple of things. Let's just say it's not precisely always Canada Day. It's a window. So I usually say 2 weeks before, 2 weeks after. Okay, but Canada Day is, the normal day. Okay, great. Now, is it for everything? Often. Why not the yens, though? So what's going on? What is making yen pairs up? What is creating that? Is it normal? Does it fit within the 20-year model? Which is funny. That's a senior citizen in the modeling world, isn't it? Does it fit within the 20-year norm, Don? Is what's going on in the yen pairs normal? It's not what they're doing, Frank. It's just, is it normal? Or is there something unusual going on? Don, if you're not sure, just type in a question mark. Yeah, central bank bond purchasing program. Okay, so that's the answer. Okay, it's unusual, and there's a special program going on. So that's that. Okay? There's something unusual going on. We call that central banking policy that creates a weak yen. So as long as that policy is happening, what is influencing the market is not the normal buying and selling in the marketplace. You have the buying and selling in the marketplace plus the central bank. Okay? So it's not normal. So it would not fall into the category of normal seasonality. Okay? And that's what's happening. So you can't apply normality to a special situation. Okay? All right? Yeah, boy. Okay? No, well, even though there might be a hike, Richard, I don't think it'll change the direction of the yen. It might change the rate of change. Okay, so quant box. So like there's a debate right now. You'll hear this a lot on TV, on Bloomberg and CNBC. They have guests that come on and they tell you what they think and what they guess about the yen. In particular, not just the yen, what the Bank of Japan is going to do. Will they raise interest rates, for example? Let me show you what being a boss is like. Because when you're a boss, you listen to the people on TV and you say, these guys are guessing, they're ill-informed, they don't know what they're doing, they don't have good data, they don't do the research, they don't do the homework, and their opinion has almost no value. That's what a boss would say. So like when you go to central banking, let me expand this. Okay. And we go to yen. Okay. We've known for quite some time that the Central Bank of Japan has told us that they're going to raise interest rates, and they're going to raise interest rates several times, and they're going to raise them in the next 18 months to 0.6, which is sort of an aggregate average, so you could round that out to 0.5. Okay? But we have it all plotted out here. We've known this for 6 months. We knew it was coming. Why? They told us. The Bank of Japan told us. We don't guess. Guessing's for amateurs. Losers. We are informed institutional traders and investors. We have the data. And we've plotted it out 18 months in advance. And we've organized our thoughts to biggest winner to biggest loser. Yeah. And so why do other professional traders go on TV and they tell you their opinions and their guess? Oh, well, we think the Fed, the Bank of Japan they might do this, they might do that. We think no. Why don't they just know? Why don't they just say the Bank of Japan has told us? Do you know why? They didn't do the homework. They don't even listen. They have models and they have experts and they do their best guess based on macroeconomic data, but they don't actually listen to what the central bank. Do you remember back in January, the whole market and all the experts on Wall Street were talking about 6 interest rate cuts? Do you know why I said that was ridiculously stupid? Because the Fed already told us back then 3. And all that guessing is amateur hour. The only difference is those amateurs had billions of dollars. They should all be fired for incompetence. You don't have to listen to any of these knuckleheads. You are a completely independent thinker. And that is your alpha, by the way. You're going to make better trade decisions than even multi-billion-dollar professionals or the experts sitting at the top of a giant Wall Street bank with a staff of hundreds of people, and you have better data. Think of the power of that. That's your edge. That's your edge. You're going to make better decisions. And I think that's super cool. Okay? Okay? Well, Caitlin's like, hey, what about peso if interest rates are falling? Well, if they're doing it in line with other central bank cuts, then it's neutral, isn't it? Maybe on hell. Maybe, but it's you know, I don't know. I don't know how you feel about it. If they were saying it, we call that as selling your book. Okay, that's what they call that. Where you go in and they're like, okay, we know this is bullshit, but we're going to say it anyways because it's going to help us make money and keep our clients interested in trading. They're throwing chum to the sharks, right, on hell? Because it'll increase trading activity, it'll increase consulting fees, it'll increase fear, it'll increase churn, more trades because of all of this stuff, and then it never shows up. Well, then they're lying to their clients because it'll help them make money. How do you feel about that? Well, once again, if you're making your own decisions because you're the boss of your own trading firm, and I want you to have your own trading firm, and even if you're just trading on a laptop in your kitchen, I want you to feel like you are a trading firm. And you look at these guys and you're like, I think these guys are lying to their own clients. They're selling their own book. They're dumping chum into the market because it's going to benefit them through fees and churn. You're like, what a bunch of scumbags. And then you feel really good about yourself because you make your own decisions. You're well informed. And then when you meet with your clients on hell, when you're trading other people's money, you can sit down and have a conversation and say, well, this is what these Wall Street yahoos are saying, and this is why they're saying it. And it's unscrupulous. And here's what you believe reality is and here's the data, and you show them. And you say, well, this is what we wanted. This is what, is going to happen with your money, your investment. This is what we're going to do based on reality and real research. And why you're better as a small trader than a $1 trillion bank or a multi-billion-dollar hedge fund. Because you're trading with your clients, not against. And in particular, when you explain you have the internal fund and external fund, like I talked about yesterday, you say, hey, I got 100% of my net worth riding on the same money and same trades as your money. Okay. So let's go to that peso question. Okay. Now, does cutting interest rates help the carry trade for peso? No. But there's also a relative, like how much do they change relative to other central banks? Now, in this case, the Fed has not cut, but the Bank of Mexico has cut. So in this case, that's negative. But if the Fed was cutting and the Bank of Mexico was cutting, then there'd be no change because the relative difference in interest rate, the carry, would, relatively stay the same. And that would probably neutral out. But you can see these moves going back a year ago. And there is a relationship, isn't there? They cut, it weakens. Okay? Yeah. And this goes to the other question from earlier. Will the new Fed policy impact the markets? Yes. So I want you to think about this. It's cheaper to do business in the United States. Will that make U.S. companies more profitable or less profitable? the cost of doing business in the United States as an American company is cheaper. Is that good for American companies or bad for American companies? What does it do to profitability? Oops. The expected return of a stock is equal to the risk-free rate of return plus the beta times, okay, the expected return of the market minus the risk-free rate of return. Okay. What this says, if the Fed cuts interest rates, so we're going to count the risk-free rate of return not as a treasury yield, but just as the Fed funds rate. So if this number falls and this number falls, okay, okay, what we're talking about here is opportunity cost. Okay, your opportunity minus cost. Okay, so when you add all of this up, when the Fed cuts interest rates, doing business in America gets cheaper. Therefore, the profitability of individual stocks go up. And because the opportunity cost is falling, okay, now you can delete everything else. What does this say? Individual stocks are likely to go up because their income minus expenses. Now, not all expenses get cheaper, but what we call debt service. Okay? And I talked about this in QuantBox a little bit, actually. I'll touch on it again. If you're a smaller business, so you're in the Russell 2000, you probably don't own your factory. But if, let's say, you own the land and the building, you may not own the equipment. You just lease them. Maybe a better way of thinking about it is, let's say you own a fleet of delivery trucks. You lease them. And the cost of the lease goes up and down with the change in interest rates. So if your income is fixed because you have good clients, okay, but your expenses get cheaper, your debt service, the amount you own on your lease every month is $1,000 cheaper than the month before. Well, now you're $1,000 more profitable. And we know the value of a company is based on profits. So the expected return of a stock goes up, but since it's all companies that borrow, because even if they don't go to a bank to borrow money like a Russell 2000, an S&P 500 company might issue bonds, right, and that kind of stuff. So, but there is a relationship between the Fed funds rate and even the bond market. So if it's across the board lower cost, no matter what kind of company you are, then all companies, not just this one particular company. That's the expected return of an individual stock. But this is the expected return for the entire market of stocks, all stocks like S&P 500. Okay? You see what I'm talking about? And so to answer the question, if the Fed cuts interest rates, what's the likely outcome in the market? Nobody's going to complain. Oh gosh, now we're more profitable. Yeah, I cover it in the stock trading course in extreme detail. Okay. And so it's helpful. Every finance major at every major university or any university learns that model. Now, I don't like the way it's taught. And it's funny because the way it's taught implies that the value of a company is still such that you can derive the value in the same way you derive the value of a bond. It's called CAPM, Capital Asset Pricing Model. Now, in the 1950s, okay, I'll put it up here. That was CAPM. Oops. In the 1950s, people would buy Coca-Cola stock or General Electric stock or AT&T stock, and they would hold it forever. And they were derived by the amount of income minus their expenses, and that you'd come up with a very logical, intelligent number, like a bond. The stock markets don't trade like a bond anymore. Huh? Roaring Kitty makes a company go up 50% in a week. NASDAQ has probably almost no value for half the companies there. But we're guessing. We call that growth. Oh, well, they're not great companies now, but they're going to be. Okay? And the models don't work out perfectly anymore. Right? Right? Because that's not how the market works anymore. But in the 1950s, it did. There was very little difference between a Coca-Cola bond and a Coca-Cola stock. And so this is what the model was used. But the same crap is still taught in business school. And when the kids don't know any better, they're like, oh, okay, it makes sense. Now, right? So now it's, the way I teach it is more of like, it's a directional model, but it wouldn't give you a value, right? Okay. All right. Foster has a question. Having problem installing. Okay. There's an easy fix. You paying attention, Foster? I'm going to show you. Some people ask questions like this and then leave. And I just want to make sure you're here. I know the mistake you're making. I need to confirm you're here and listening. You ready? Good. When you install it, there is like in step number 2, I think, maybe step number 3. It asks you where to install. So when you don't know what to do, this is when mistakes happen, this is what you're likely doing. You say, go ahead and install all the indicators in my download folder. Guess what? MT4 doesn't talk to your download folder. So what most people just do is they click next. Well, of course, that's wrong. So when you get to that screen and it says, hey, dude, where do you want me to install the files? You have to tell it, where did you install your MT4? So you go File, Open Data Folder. Okay, I want to confirm you're following this. You following me, Foster? This is critical. Okay, click on Open Data Folder, and it'll show you where you installed MT4. You see, bases, configuration, history, log, MQL4, profiles, templates. Guess what? All the profiles go in here. All the templates go in here. Okay, some of the EAs and stuff go into certain spots in the MQL folder. So don't touch any of these. The installer already knows where these should be, but it doesn't know where you installed MT4. So you go up here and you copy the URL of your data folder. That's it. Just right click it, copy address. Then you go back to the installer window that's saying, hey, Foster, where did you install your MT4? And you give it, right? You hit paste, and then you hit next, and then the installer says, okay, now I know where this data folder is, so install all the EAs in here, install all the profiles here. Install all the templates here, but it has to know where here is. Okay? And it's this folder, right? So it has to know where that is. Easy peasy lemon squeezy. Done. Solved. If you got a problem, I'll solve it. Check out my hook while my DJ revolves it. How about that? Stop, collaborate, and listen. Ice is back with a brand new invention. Something grabbed a hold of me tightly, flow like a hawk both daily and nightly. Will I ever stop? Yo, I don't know. Turn off the lights and I'll glow. Beautiful lyrics. To the extreme, like a punk with a candle. Well, no, like a chump with a candle. Anyways. All right. Nice. Cool. Let's take a look at the commodities. Everybody doing all right? Everybody doing good? Okay, we're at the bottom of our range. Bottom of our range. Look at that. It touched it. Look at that. Whiskers, man. Touched it, pop. Okay. Notice we're not in a trend, so you don't use the pivots. You use support and resistance. And look how wonderful they're working. There's the top. There's the bottom. Lovely tulium. Okay, my WTI having another great day. Dropping. Cool. Into your buy zone. Cool. Cool, yeah. So you still, it's an elevated buy. It's more dangerous than your typical buy, but you could. Opportunity 1 is right there. Okay. Okay. We can go to confluence bullish. Okay. And you'll see what happened was the projected high for this week was right there. We hit the top and now stopped and could come down as low as 82 again. Huh. Well, if you didn't know that, you didn't take profit. And so most people would buy a dip around this price, but it could go down to this price. So you got to be careful. Okay. Yeah. Now, if you recall last month, I got in at 76 or something, right? 76, I think it was. So I got in here and I exited here. By the way, this is a counter trend. Okay. I only teach one counter trend trade. One. This is a setup for a counter trend. Okay. Beautiful. Cool. Cool. Cool, man. And if you don't know how to counter trend, pay the $88. Just capitulate. Give up. Okay. Make me rich on your $88. I'm going to go out and buy a Lamborghini with all the $88 I collected. If you don't see the value in 88 hours of lectures, I mean, you should say it's dumb that I've made them so cheap. And that you're like, okay, I know what this guy's doing. Yeah. And I hope you don't think, oh, he's going to get rich on my $88. I hope you don't think that. Because if you think that, it's going to really be hard to train you. You are so scarred that your skepticism is going to like block out any training and advice. You're like uncoachable. You're broken. That sucks, huh? Yeah. So we got that role reversal I talked about yesterday. The thing is it going to continue higher? This might have been the day trading group I did this, though. If I didn't do it here, it was the day trading group. Cool little opportunity there. Now, there were some fundamental changes last night in gold. So Ruda, and I noticed some of you have been posting it. Okay. Is Jay Powell going to come out at the Sintra ECB meeting and tell us something we don't know? Like, oh yeah, we've decided to cut interest rates in September. No. So we're good. There's nothing new. You maybe you get some volatility, but I don't care about volatility. Volatility is bad. Okay. Is it going to tell us something new about monetary policy and overshadow Lagarde and these? No. So yeah, it's going to create some vol, but vol's bad. So like what I'd rather talk about is that QuantBox last night told us there was a fundamental change towards buying gold. And now it's up. Well, that's an interesting coincidence. Right? That's an interesting coincidence. I have it over here. Okay. So 3 hours ago, I got an email from QuantBox. So this means I'm a subscriber and I upgraded to the email alert service, which is 80 cents a day or something. Yeah, 80 cents. And it said, buy gold, buy the S&P 500. So now gold is up. Let's take a look at S&P 500. And you knew this quantitatively at 6 a.m. New York time. It's now 9:30, so it's almost 10. So almost 4 hours ago, you already knew this. Do you see what you guys are missing if you're not part of this? Like, you're trying to figure things out randomly. This was done quantitatively. So like if I bring this back, it went from a 4 to a 6. So two things changed economically. Over here, 4 things changed economically. It's macroeconomic, it's quantitative analysis of macroeconomic data. Okay? Now, I think if you go pre-London, some of this was indicated there too. Yes, pre-London, you had a bid on S&P 500. Yeah. So you had all this time to prepare. And now it's up. Huh. Well, that's helpful. Huh? That's helpful, isn't it? Yeah. Cool. What a neat thing to have. It would suck not to know these things, huh? Yeah. Yeah, it would suck not to know these things. Yeah. Let's see how our yens are doing. Cool. How many do I still have mine open? Yeah, still got mine. Okay, looks like it's going to want to make a higher high. Today's target, by the way. Okay. Today's target, very simple trade. We were here yesterday during the day trading group, and the trade plan was this. Oh yeah, we have JOLTS coming up. Okay. We had that on many of the yen pairs, though. Like I think Aussie and CAD, although this is weekly, not daily. Aussie's lagging right now. That's why it's behaving the way it is. And then you go this one out here. Same thing. So last night in the day trading room, same thing. Okay. Target is up here. Okay. All of this was done last night, guys. So once again, if you log into New York and you're like, what's up, fellas? What are we trading today? Well, there's one more push and then we're going to take profit and be done for the day. The plan for today was buy here and target up here. So it's funny when people log in like halfway through and they're like, so what's up, fellas? They're like, well, I don't know what you're going to do, but you've missed half of it already. And now you're going to buy at resistance, which is dangerous, right? Well, there are also text messages. I get them all the time, Bernd. I get them all the time. Let me check my phone. Because QuantBox is watching itself for me all the time. So the last one I got was yesterday at 1 o'clock in the morning. And it was a Kiwi Swiss play. And before that, it was Sunday night, Kiwi Swiss again. Then on Friday at the close, Euro Swissy and Kiwi Swissy. So yeah, so I get those. No, but they're more urgent, Bernd. That's the thing. They're more urgent. That's why you're emailed. And they're sent to you exactly when they've occurred. I wouldn't text them to you if they were not more urgent. But anyways, look at it. So we're doing well here. The question now is, JOLTS is coming out. So check this out. If you are part of QuantBox, you go to labor market data and you look at JOLTS. And okay, we want something below 8 right now. Current average is 8.84. Oops, let me expand this out. But if I go out 24 months, okay, you can see the average is way up there. So we're looking for something less than 8.1. So when you get the number, go ahead and post it. So the way the market's behaving, whatever Jay Powell is saying, the market's going, oh, I guess he means they're going to cut. Remember, they can change that opinion very quickly. That's the problem with opinion-based trading versus quantitative trading. So there's the 8.1 I just showed you. It's nice that QuantBox has that, huh? Yeah. We want to get it 7.9. Anything below 8 is desirable, which means the Fed could cut sooner than later. Did you click thumbs up? Were you enjoying the shoe? Oh no, disappointment. That's going to delay a cut. That's a disappointment. Job openings went up. Disappointment. Yeah, disappointment. A giant wah, wah, wah. Oh, man, huh? This will give you a similar outlook that I have on QuantBox. Yeah, too bad. Yeah, that's a miss. Too bad, man. Too bad. My guess is dollar strength, huh? Oh, this one's all over the place. Dollar up, dollar down. Whew, look at that. Really nasty volatility. Oh, there was a revision, OG? Thank you for that. Look at this. 2 hours up, 4 hours down. That's nasty. 12 hours down, 48 hours up. Oh, yuck. I don't like this at all. That's nasty. It's not a good trade anyways. Pretty simple, just not a good trade. No matter what happens. Look at this, up and then down. Down and then up. Up and then down. It's kind of nasty. Ugh. Blech. Makes me sick to my stomach. Oh, yeah. Blah. But here's the guess. The Fed's not going to be able to cut interest rates in September, and that's likely to lead to a delay in the interest rate cut, right? Or to dollar strength. The delay in interest rate cut is not dollar weakness. It's not risk on. It's more likely risk off. So I might think today dollar strength could appear. Could. It's logical. I don't know what's going to happen, but I would assume dollar strength could appear and that the stock market could come down with disappointment, subject to, revision analysis. Okay. So about half of you have not clicked the thumbs up button. Did I do something wrong? Did I offend you? Did I tell too many stories? You didn't like the capital asset pricing model? You didn't appreciate that? You didn't like the overview of Mexican peso? That wasn't pleasing to master? Didn't like those yen pair setups? What's going on, guys? Cool. Well, thank you for clicking the thumbs up button. I will leave you to it. Tomorrow is a very, very important and busy day. Be prepared. Okay. Oh, and like I said, there are videos on the YouTube channel for QuantBox that you should consider watching. If you're not a subscriber, at least I'm allowing you to get the data delayed. But how to trade without an underlying intrinsic trend is what's there now. And then the one starting very soon is this one, how to trade with seasonality. Okay. I think worth the watch. So anyways, peace on earth. May the pips be with you. May your profits be above average. Please have a wonderful day.